Okay, well, it's a great pleasure to meet you again, Shaun. The first time I met you was in CNBC, was in the green room. I was about to go on, and I just got talking to you, and I think we had quite similar views about the way the markets were working at the time.
Yes, I remember it well.
And I thought, yeah, this guy's really good, obviously because you agreed with me. But so maybe you could tell us a little bit about the way the top-down works, in other words, how your asset allocation committee works, versus the kind of bottom-up information that you feed into your process.
Yes, so we think very much from the top-down view, from macroeconomics. What is driving market cycles? Is it inflation? Is it policy stimulus? Central banks lowering interest rates? Is it earnings improving, margins improving? What is really fundamentally driving markets? So we think very much the top-down drivers. And then from a portfolio perspective, we're thinking very much about how much risk is really in portfolios. Often you've got lots of views, lots of things about the dollar, about markets. And actually, when you distill it down, sometimes quantitatively, you find you've probably only got 2 or 3 factors really driving your portfolios. So we like to think about what is really driving your portfolios, down to the simplest elements to really understanding your risk in a lot of detail.
Now, everyone describes Nutmeg as a Robo fund. Now, obviously, if you've got just a computer which is running a portfolio, it wouldn't understand certain things. So, for example, political risk or Marine Le Pen or Brexit. So obviously this is a place where you can really add value. I mean, how often do you feel you have to kind of delve into the machine, as it were, and to alter the weights?
Yes, so the automation is very much about helping clients come on to the service, to use the service, to understand people's risk, use a lot of data to understand people's risk, and to make the business very scalable, very efficient. But actually there's an investment team, I lead an investment team here at Nutmeg, that are making decisions on a daily basis. So during the Brexit event, we were very much focused about political risk. We thought the risks about Brexit and a yes vote were really very much understated. So we were doing things like buying gold, we were earning more dollars and yen, and earning lots of long-dated government bonds, which in the event really helped you in the subsequent days. When the UK stock market was down 7%, generally our portfolios were positive. So some of these decisions around political risk were really important through that period. So it's not a robot running these portfolios. Yes, we use a lot of quantitative tools and automation to help us, but actually it's people making these ultimate investment decisions.
And you did a great job on Brexit, actually. And I think you've actually put that on the website, haven't you, as an example of...
Yes, I think it's a really live example. I think actually a lot of our clients were shocked. They thought that the world had ended, and actually it hadn't. For a multi-asset portfolio, when you're global, not just the UK and you have other assets, you can actually produce a really good result. So that was a really good experience for our clients, learning more about investing, particularly for the first timers hadn't experienced this sort of world global view when you come to investing. But yes, political risk is very important when you think about portfolio construction.
I was fascinated to look at your asset allocation committee, because it's something I've sat a lot. I mean, I've been on many asset allocation committees in the past, because previously I was a strategist in asset allocation. So the actual people that sit on that committee were fascinating, a very broad range of backgrounds. Is that a deliberate thing on your part?
Yes, it is. So we have the team that runs the daily portfolios, thinking about on a monthly basis, well, how should we change our portfolios, or even on a daily basis. And then we have an advisory group that inputs into that and say, actually, does the investment team have the right processes? Are they thinking about the right things? Can we give them a different view they should be reflecting on? That's really important to come from a different view of the world, not a pure financial market, sometimes for the politics we talked about already, from economics, from the worlds of tech as well. So we get a lot of input from the tech world, which is very fascinating about how the world is changing. So it's really good to get different views. And actually, if you look across the Nutmeg office, you see a lot of people haven't worked in financial services before. So they come with a different perspective. They come very much with a customer perspective rather than a traditional finance view, which can be very, very different.
It's odd, isn't it? We all seem to live in this bubble. We all read the FT, we all look at Bloomberg. So it's very easy to get into that kind of groupthink mentality, isn't it?
Yes, definitely is. I think they come very much with the customer perspective. They're, well, why is it like this? And it's actually, well, it is often. And actually, it's very challenging for us as investors and for financial people to think about, well, maybe this should be different.
So in terms of the way you see markets at the moment, I can't resist market chat since I've got you here. One of the things which intrigued me is that you're going more overweight emerging markets. Now, just to explain, I think emerging markets are generally seen as being more risky, but when there's global growth, they've got a high leverage to that growth. So is that the way you see the world at the moment?
It is. If you think about the last 4 years, everyone's been obsessed about falling prices, about deflation as the industry calls it, and looking for what people talk about, quality companies with lots of dividends, with a lot of income, rather than very much about growth. Now we think because global trade is improving, actually Chinese growth is quite okay, but the US is firing on all cylinders now, employment is very strong. So we think it's a time to actually own more exposure to global trade improving, global growth, and that's where you want to own emerging markets. It's also where you want to own Japan stocks as well, but particularly we think that emerging markets are more attractive though. They're not necessarily very cheap, but they're probably less expensive than some other areas like the US, for example. So I think it's good to get that global exposure. Actually, emerging markets have become less volatile than they have in the past. Not going to say that's going to continue, but I think it's right to have more exposure to this global pickup in trade.
But do you think that volatility dampening is just because of this Trump trade? Because we've seen volatility crash everywhere. Yes. I mean, if you look at the US, volatility is below 12%, I think, in the US market. It's been there for quite a while.
Actually, in the Chinese A-shares market, mainland China, volatility is only 10%. And we've seen it at 40% before. So there's some extraordinary things going on. So we're never really focused just on the here and now when it comes to risk. Actually, if we look at our portfolios during really bad events, say, for example, the Asian crisis or other crises through the last 20 years, how would portfolios perform? What's that bad month you're thinking about? Not just this low volatility environment now, but actually how bad could it get and how much diversification in your portfolio. So we own gold, which is relatively unusual for us. I mean, adds a bit of diversification. We also have some Japanese yen in portfolios. These, as you know, classic kind of hedges, as we would call it, but some defensive parts of the portfolio.
Presumably we're about to trigger Brexit. Perhaps we've already done it. Are you worried about the effect on sterling?
Yes, we do think about currency very much as an active decision. So maybe when we buy the US market, own the US market, we think we own dollars as well. Often many private investors forget about the currency. Often the fund or the ETF is traded in sterling, it's priced in sterling, so you don't think you have any dollars, but absolutely you have currency exposures. So think about that very actively. At the moment, it's been sort of obsessing our decisions around currency. Well, how much dollars should we own in portfolio at the moment? We think the sterling has a bit more weakness to come, but we're getting close to the bottom, even though the Brexit machinations are going to go on for some time, maybe beyond the 2-year horizon we've got coming up. So we think very much about currency as an active decision, as part and parcel of any other investment decision we make. So I think we're leading to a circumstance where we're probably looking to maybe hedge all of our foreign currency exposure. I could see us getting to that point perhaps in the next year, because it's going to be a very big risk for UK investors when they're owning overseas assets. Sterling could look very, very cheap, maybe 20%, 30% too cheap if we get a good result on Brexit, soft Brexit with access to the single market. So it's a really important decision when you should think about now.
That's interesting. A 30% upside is there. Okay.
On a good result on Brexit. So that's very much the optimistic case, but it's certainly not factored into markets. So I think that there's not really any big positions being taken against the pound at the moment. And if we move towards a closer indie ref in Scotland, I think Brexit, the pound could take another leg down. But longer term, if we move to a softer exit, continued EU market access for some period after the 2 years, then I think sterling could look very cheap.
Now the Trump rally, I think it's something like 13 to 15% so far.
Yeah.
Now, assuming that they cut their corporate taxes for companies, that's going to provide some upside. How much of that do you think is already priced in? Given that, if you look at the Case-Shiller PE or this valuation measure over the long term, it's looking very expensive there.
The thing is, the US has looked expensive for some time. Yeah. I think everyone said you shouldn't own the US, and actually the US has continued to outperform. And we're really glad that we've had lots of US stocks and ignored that sort of narrative about US being expensive. Yeah. I think it's expensive for a reason. There's a lot of growth in the US at the moment. There is a lot of potential for the US to expand even margins from these levels, I think, given how strong the US is. So we've actually taken some exposure out of small companies in the US. They probably ran too far ahead of the economic news, I think, and we've taken profits on our smaller companies in the US. We've still got a big holding in the US. I think it's an important part of the global portfolio to own the US, but I think the direction of travel is for less US exposure than there is for more. We've enjoyed our performance in having lots of US for time, and one of the part of that is looking at emerging markets. Where is the next growth going to come from? I think it's emerging.
That's usually the stages in which it happens, isn't it? You get the DM surge, and then you get the EM.
Yes.
And then if things last long enough without a crisis, maybe frontiers, but it's a long way down the line.
I think it's a long way down the line. You need to think about liquidity. Can you buy and sell, for example, Nigerian stocks very easily, or Vietnam? That becomes more.
So talking about liquidity, high yield in the US, it looks like it's on fire. It's just unbelievable. It's just rallied massively, something like 16% last year, and it's looking pretty strong this year. Do you think that's got further to run?
Not much. I think it's great, attractive from a running yield perspective. It's got a good yield, more than 5%, I think, if I'm right. but the relative to investment grade bonds looks very expensive.
Yeah.
So we'd almost rather own the edges. So own Treasury index linked bonds, so inflation linked bonds on one side, and actually own equities on the other side, rather than own the hybrid that's high yield, because it is still very much a risky asset. It just looks very cheap, very stable at the moment. With oil prices falling, high yield could have a bit of a bumpy few weeks.
That's true. And in terms of the duration argument, because one of the things, if you have very long duration bonds, you're very exposed to interest rates flopping up and down. So the trouble with inflation-linked bonds is they tend to have a very long duration, sometimes 20, 30 years. Is that a problem with having this inflation-linked?
So it is a problem in the UK. So I think duration is 17 years for the UK market. Yeah. So you're owning very long bonds. It's very volatile and can be very profitable, but also you can get burned. But the real yield is so negative in the UK. We think UK bonds are very strongly overvalued relative to other bonds. So we're actually buying US inflation-linked bonds, which have seen quite a big fall in prices, quite a big rise in real yield. So we're happy owning the US bonds compared to gilt. So we've been selling some of our UK exposure towards index-linked securities in the US.
And you think US real yields haven't got much further to rise?
Nowhere near as much as the UK.
Okay.
So I think the UK bonds look very, very expensive. So we're happy to move some exposure. I think globally real yields are rising everywhere, but it's nice to have some degree of inflation hedge. The UK bonds just look too expensive, whether you're buying index-linked bonds or whether you're buying the normal government bonds.
One of the things I wanted to ask you about, because yesterday I actually put my money into one of your ISAs, and I had a fantastic experience. I mean, the support was fantastic. I left a good review. One of the things I liked most about your onboarding was the simulator. So at some point, you go through your risk preferences, but then it actually comes up with your Nutmeg pot. It projects the value of that portfolio into the future. But it doesn't just give you a single number. It doesn't say you'll make 20%, 30%. It gives you error bars, which I've always been a big fan of. But it says, there's a 1 in 20 chance that it'll actually go down by this amount, as well as a 1 in 20 chance that it will go up. So how does that work?
So we use quite conservative estimates of what we think future returns are. Not the 8% you could have got from equity markets in the last 20 years. It's much, much lower. It's closer to 6, even for the highest risk portfolios. We include fees as well, because that needs to be realistic. So we've got quite simple, low assumptions for future capital returns from where we are now. So it's not just thinking that the return will mirror the past. We actually need to think about the future. The future is going to be very low cash rates and lower asset class returns. So that's baked into our projections. We also think about how has this gone wrong in the past. So we talk about those bands. How bad could it be on a rolling basis for some of your portfolio returns? So we do show clients, what could be your worst 12 months in this kind of strategy? What is a bad year for this strategy?
So you kind of see it coming before,
yes,
before it actually happens?
It's very important to show customers what it could be like before they go to sign up and before they put money in, because we need to warn people that this can be a bumpy ride. But also through their investing experience with Nutmeg, we need to coach them. So, for example, when markets are very volatile, we need to talk to customers more. We need to get customers coming, talk to our customer support. We need to improve the education about what markets do. For instance, 20% fall in stock markets is actually relatively normal, almost annual event.
That's right.
And it can feel like the end of the world for a new investor, even if they've got a lot of risk tolerance and they've got a long time frame horizon. So rather than people go, well, I've lost 10%, this is the time to finish, I didn't enjoy that. We need to bring people through that experience and see the other side.
It's interesting, it's on your form. When you actually sign up for this, it says, would you mind making a loss on your investments? And as I said, no, I wouldn't mind. It made me think that actually when it actually happens, you may not feel so peachy about the whole event.
Absolutely. So we use a lot of data to predict behaviour and say, actually, based on your behaviour, based on your risk profile, based on how markets perform, this may be a good time that we should be contacting a customer and saying, this is how what markets are doing. If you want to talk to someone, this is a good time
so you
to do it.
proactively
So we
contact
proactively use data.
Great.
So this is really the frontier where you go, is actually how can you use data to inform people's experience of investing, and how can you bring people through this journey to focus very much on goals. So you'll see that the onboarding process is designed around what are your goals in investing. Some people just invest, but some people it may be a house deposit, which could be a short time frame, or retirement. If you focus people on goals, they're much more anchored to the goals and less sensitive to market volatility. So when markets are turbulent, think about why you're saving. And one of the best ways to save is actually to increase the money you're putting into markets and to increase to get to your goal earlier rather than relying all on market returns. So the more you anchor to goals, the less people are sensitive to market volatility.
Well, that's an interesting way of putting it. And I love the fact that you could actually tailor your message according to what you know about customers.
Yeah.
Now, I think you were one of the driving forces behind moving from a fully managed offering, which is, I think it's about 0.75% per year if you've got less than 100,000, to the fixed allocation portfolios, which are about 0.45% per year. So what was the thinking behind that?
The primary reason is we were talking to customers about portfolio management. I have a lot of interaction with customers, both through our customer support and also interaction with customer groups and meeting customers. What do they want us to do, and what's really interesting to them? There is a definite part of our customer base that likes the idea that no one's touching anything. That no tinkering would be the way they would expect it. And
so all you do is just rebalance the portfolio?
Yes, so we build portfolios that I'd be very happy to put in a box for 5 years or maybe 10 years and open the box and actually this is still a good portfolio. So it's got a lot of core asset classes in it. It's got holdings that we're prepared to carry forward over 5 years. It's things that we think are good through economic cycles. So, for example, gold's not in portfolios because I don't think it's a really good buy and hold asset, for example. Really well constructed around risk, very solidly built, and they're just set to travel with markets. If they get too far out of line with risk, it's automatically rebalanced back into those fixed allocations. For some investors, particularly experienced investors, that's exactly what they want. Whereas other investors really do like the idea that me and the rest of my team are actually thinking about portfolios, thinking about Brexit, thinking about the French, the Dutch elections.
You want to make sure you don't sleep.
Exactly. Work harder. So people do like the idea that we are on and reacting to market events, reacting to political events, thinking about how the future could change compared to the past. So it's very much a different stylistic way of investing. I think both approaches have their merits. Obviously, as the person managing the portfolios, I would say that managed is better, but they're both designed to be amazingly good portfolios and very low cost. The funds we're using are super low cost, and we like to get those costs down. But given that there's less intervention with the fixed portfolios, they are charged at a lower rate because there's no human involvement with the day-to-day.
Okay, so final question for you about demographics. Now, a lot of people have been talking about people aging in China as well nowadays, but mostly in developed markets such as the UK. Do you think that's going to have an effect on long-term returns of asset classes? And is it something you think about?
It's something we think about, we worry about really. I think people's expectations of what can be achieved is very much based on the past, and 8% return is very unlikely in the future. So that's something we do think about. Bear in mind there could be other sources of return coming out from different demographics, from different markets, from different asset classes. So returns could improve. It's not necessarily a one-way street, but we know the surest way to improve returns is to get your costs down. So we do focus very much about getting our fund costs down, having a really good competitive management fee for us, thinking about our technology that could potentially lower the cost of investing going down, talking to product providers to get the best possible product we can for investors to get the fund costs really low. So there's two sides of the coin, improving returns but also reducing costs as well. So I think we have a kind of strong emphasis on trying to get that cost down as well.
That's great. Anyway, thank you very much for your time, Shaun.
Thank you.
It's been great.
Pleasure. Thank you very much. Good to see you again.